You're here because you want to get smart, fast, right? We get it.
Right.
You're after those aha moments without feeling like, you're swimming in info.
Uh-huh.
Today, we're taking a deep dive into something that could be a real game changer if you've ever dreamed of building your own custom home, construction loans.
Exactly. And forget spending hours searching online. We've dug through some really current research articles from just this month, late April 2025, to pull out the crucial stuff you need.
Yeah, our focus today is pretty sharp. We're zeroing in on construction loans, especially the lower down payment options that can make building feel possible,
Right.
and also that streamlined process of a one-time close loan.
Mm-hmm.
So if you thought building your dream home was just, totally out of reach because of the big upfront cash needed, well, maybe think again.
Mm-hmm. We'll even touch on how working with what they call a turnkey builder can make the whole journey a bit smoother.
Okay, let's unpack this. Where do we start?
Well, first, just the basics. A construction loan is, pretty simply, financing specifically for building a new home, not buying one that's, already standing.
Gotcha. So not your standard mortgage.
Right. And traditionally, there were kind of two main ways people did this, but one way is really becoming, well, the preferred route now because it's just simpler.
Okay, what's the first one? The older way.
Yeah, that's often called the two-time close loan. Picture this. You get one loan approved just to cover the building, cost the materials, the labor, all that.
Yeah.
Then, after the house is totally finished, ready to move in, you have to go through the entire loan application process again.
Again? Wow.
Yeah, a whole second time to get your permanent long-term mortgage. So you're looking at double applications, double closings, potentially double sets of fees.
Yeah.
It just adds up more time, more stress.
Yikes.
Oh.
Okay, not ideal.
Yeah.
So what's this other way? The modern way?
Exactly. That's the one-time close loan, sometimes called OTC, or a construction to permanent loan. And like the name says, you go through the whole loan process, the application, the underwriting, where they check everything out, the closing just once.
Just once.
Just once. That single loan pays for the construction phase, and then, and this is a really neat part, it automatically converts into your regular permanent mortgage once the house is built.
Okay, that already sounds way better. One and done.
Yeah, potentially saves time, definitely simplifies things.
It almost sounds, I don't know, too easy.
Okay.
But you're saying the advantages keep coming.
They really do. I mean, start with the obvious. Simplicity. We're talking way less stress, much less paperwork shuffling back and forth, fewer headaches compared to juggling two separate loans.
That alone sounds pretty good. Less paperwork is always welcome.
And it can often save you actual money, too.
Well,
Think about those closing costs, appraisal fees, title fees, recording fees. You avoid paying a lot of those twice.
right, those duplicate fees can add up to thousands. So this one loan could literally lower the total cost of building the home.
Potentially, yes. But maybe even bigger is the rate flexibility advantage with a one-time close. This is huge.
Okay, tell me more. How does that work?
So picture this. With many of these OTC loans, the interest rate during the actual construction period, it kind of floats. You might just pay interest on the money that's been drawn out so far to pay the builder.
Okay, so it floats.
But the key is your permanent fixed interest rate, the one you'll have for maybe 30 years. That often doesn't get locked in until construction is nearly finished.
Ah, I see where this is going. So if market interest rates happen to drop while the house is being built.
Exactly. Building can take, 6 months, 9 months, maybe more. If rates go down during that time, you have the chance, the opportunity to lock in that lower rate for the entire life of your mortgage.
Wow. Okay, give me an example. Like if rates dropped 0.5%.
Yeah, say on a $400,000 loan, 0.5% could easily save you over $100 a month. And over 30 years, we're talking tens of thousands of dollars in savings. It's a really significant potential benefit.
That's a serious potential upside. But what if rates go up during construction? Are you exposed then?
That's a great question, and there's good news there too. Many lenders who offer these one-time close loans also give you a rate cap guarantee right at the beginning, at the initial closing.
A rate cap. So like a ceiling.
Precisely. It means if rates shoot up while they're building, your final rate won't go above that pre-agreed cap. So you've got protection on the upside, but still the potential to benefit if rates fall.
Okay, that does sound like the best of both worlds, managing that risk.
It really helps manage that interest rate uncertainty during the build.
And you mentioned builders like these loans too, especially in Texas.
Yeah, we're hearing that many builders do prefer them. It seems to streamline how they get paid. You know, those payments they get in stages as work gets done, they're called draws.
Ah, right, draws. We'll talk more about those.
Yeah, the OTC loan process can make that draw process smoother and more efficient for the builder, which means fewer delays for everyone.
Makes sense. And I imagine there's some peace of mind for the homeowner, too.
Absolutely. Knowing your final permanent mortgage is already basically set up before the first shovel hits the ground, that's huge. You're not worrying at the end, oh no, will I still qualify? Or will the terms be okay? It adds a layer of security.
Okay, so the one-time close definitely seems like the smart way to go for a lot of people. But let's tackle that big elephant in the room, the down payment.
Right. The big question.
Because everyone assumes you need, like, 20% down saved up, which is a massive hurdle. Is that still true?
Well, here's some really good news, particularly if you're looking to build in Texas, based on this recent info from April 2025. Needing that huge 20% down, it might not be the reality anymore. There are some genuinely exciting lower down payment options out there.
Okay, now you've got my attention. Lower down payments. Tell me specifics.
Okay, let's break it down. First up, you've got FHA construction loans. These are backed by the Federal Housing Administration.
FHA, okay. I've heard of those for buying existing homes.
Right, and they have construction loan versions too. And often the down payment requirement can be as low as 3.5%, 3.5%.
Wow, 3.5%.
Yeah.
That's a world away from 20%.
It really is. Plus, the credit score needed can be more accessible too, sometimes down around 620. So this makes it a real possibility for, many families, maybe even first-time builders.
That's fantastic. What else?
Then there are VA construction loans. These are for eligible veterans and active duty military personnel.
And the VA loan benefit is usually?
Zero down payment.
Zero?
Yeah.
Seriously, for building a new house?
Yep. 0% down payment required for those who qualify through the VA. It's just an incredible benefit. And again, the credit score minimums can be similar, maybe 620 or so.
That is truly unbeatable for those who served. Amazing. The other options.
And then you have conventional construction loans. These aren't backed by the government like FHA or VA.
Okay, so standard bank loans.
Kind of, yeah. And even here, there are options now that start as low as 5% down.
5%. Okay, still much better than 20.
Definitely. Now, for a conventional, you'll usually need a slightly higher credit score, maybe closer to 700, and the lender requirements might be a bit stricter overall. But still, 5% down is a very achievable goal for many people.
So really, between FHA at 3.5%, VA at 0, and conventional starting at 5%, that dream of building really might be closer than a lot of us thought.
Exactly. There are different paths depending on your specific situation and qualifications.
Okay, this is great stuff. Now, if someone's thinking, all right, maybe I can do this, what are some other key things they need to understand about the process? You mentioned builder draws earlier.
Right, the draws. So the lender doesn't just give the builder all the money up front. That wouldn't be very safe.
No, I guess not.
Instead, the loan funds are paid out in stages, or draws, as the builder completes specific parts of the job according to the plan.
So, like, after the foundation is poured, they get a draw, after framing, stuff like that?
Exactly. The builder submits a request for a draw. Often there's an inspection to verify the work is done right, sometimes by a specific HUD-certified inspector.
HUD, Housing and Urban Development.
Right. They check it against the plans. And often, you, the homeowner, might also need to sign off saying, yep, looks good, before the lender releases that chunk of money to the builder. It's a checks and balances system.
Keeps everyone on track and accountable. Makes sense. What about the land? Does that have to be sorted out separately?
Another great point, especially for the one-time close loans. Often you can actually wrap the cost of buying the land right into that single loan.
Really? So you don't need a separate land loan first?
Not necessarily. You find the land, you find the builder, and the one-time close loan can potentially finance both the land purchase and the construction all in one go. Makes it super easy.
That definitely simplifies things. Now, what about choosing the builder? How early does that need to happen?
That's pretty important. You generally need to have your builder picked out, or at least be very close, pretty early in the loan application process. The lender needs to approve the builder, too.
They approve the builder.
Yeah, they'll look at their financials, their license, insurance, track record, things like that. So finding a qualified builder you trust is a key early step.
Good to know. And the building itself, how long does that usually take? Are we talking years?
Oh, hopefully not years. It really depends on the house, how big, how custom, But typically, you might be looking at something like 6 to 12 months from breaking ground to getting the keys. Highly custom homes can definitely take longer, though. Your builder can give you the best estimate.
Okay, 6, 12 months seems manageable. Right now, people always have tons of questions when they look into something like this. Let's try and hit some common ones. First up, contingency fees. Does the lender tack on extra money just in case things go wrong?
Good question. Generally, no. The lender doesn't charge like a separate contingency fee on top of your down payment. Now, your builder will likely have a contingency amount built into their contract price that's normal to cover unexpected stuff, like if lumber prices jump or they hit rock, digging the foundation.
Okay, so the builder has one, but not the lender. What if costs do go over the builder's contingency?
Then that's usually handled through something called a change order. You and the builder agree on the extra cost for whatever change or came up, you sign off on it. And typically you need to cover that difference out of your own pocket.
Got it. Okay, here's a common situation. Someone owns a home now, wants to build a new one, and plans to sell the old one after the new one is done. How does having that existing mortgage affect getting the construction loan?
Yeah, that's definitely something the lender looks at closely. They need to be sure you can actually afford both payments during the construction period, your current mortgage payment and the payments on the new construction loan.
Both at the same time, even if you only pay interest on the construction loan at first.
Yep. They'll look at your overall debt-to-income ratio, basically, how much of your monthly income is already going to debt, and make sure adding the new loan payment, even if it's interest only for a while, doesn't stretch you too thin financially.
So you need to show you can handle both, at least temporarily.
Right.
Makes sense. Okay, what about this? You get one of those great low or zero down payment one-time close loans, but maybe you plan to pay off a big chunk or even all of it right after you move in, maybe from selling that old house. Is there a penalty for paying it off super quickly?
Yes. This is a really important point for the one-time close loans. There can be a significant bank penalty if you pay it off very soon after it converts to the permanent mortgage, like within the first 6 months or sometimes longer.
A penalty? Why?
Well, the lender structures these loans anticipating a longer-term relationship. So if that's your plan to pay it off almost immediately, a one-time close might actually not be the best fit.
So what's the alternative then?
In that specific case, you might actually want to look at the two-time close loan we talked about earlier. The permanent mortgage you get at the end of that process often doesn't have the same kind of early payoff penalty. So it depends on your exit strategy, really.
Interesting nuance. Okay, someone asks, what kind of construction loans aren't typically offered? Like, what can't you use these for?
Generally, the focus for these specific programs we're discussing is on building a single-family home that will be your main residence, your primary home, or maybe a second home, like a vacation place.
So no investment properties, like building a house just to rent it out.
Right. Typically, these programs aren't designed for building purely investment properties where you don't intend to live at all.
Got it. And where are these loans available? Is it nationwide?
The specific lender whose info we reviewed mentioned they offer these construction loans in 46 states currently. They usually have a map or list on their website so you can check if your state is included.
Okay, 46 states is pretty broad coverage. What about the absolute bottom line on credit score? You mentioned 620 for FHAV, maybe 700 for conventional. Is that firm?
Those are good general guidelines based on the recent info, but credit requirements can definitely fluctuate a bit depending on the market and the specific lender's policies at the time you apply. Best bet is always to check their current requirements directly.
Always check directly.
Yeah.
Good advice. Okay, here's an interesting one. Can you buy the land from, say, your parents, or use your brother as the builder? Family involvement.
Okay, this depends on the loan type. For VA and conventional loans, buying land from or using a builder who's a relative is generally okay. No big deal.
Right.
For FHA loans, it can trigger something called identity of interest. FHA gets a bit concerned if the deal isn't arm's length, meaning between unrelated people acting independently.
What happens?
If FHA identifies this identity of interest because you're buying from family or using a family builder, the minimum down payment required jumps way up, usually to 15%.
15%. Ouch. That negates the low down payment benefit.
Pretty much, yeah. It's FHA's way of adding extra security in those situations. However, here's a positive twist. If a relative gifts you the land, that's usually fine for all loan types, including FHA.
Oh, so gifting is okay.
Yes, and that gifted land equity can often count towards your down payment requirement, which is great.
Good to know. What about minimum loan amounts? Can you get a construction loan for like a tiny house project for $50,000?
Probably not easily. While there might not be a hard legal minimum, the fixed costs involved for the lender in setting up and managing a construction loan, the appraisals, inspections, draws, paperwork mean that very small loans often just aren't cost effective. The fees can eat up too much of the loan amount.
So below a certain point, it might make more sense to look at other financing, like a personal loan or home equity line if possible.
Exactly. These construction loans are really geared towards more substantial building projects.
How long does it usually take for the builder to get approved by the lender, assuming they submit everything needed?
Generally, around 5 business days seems typical, but, and this is a big but, it totally depends on the builder getting all their documentation in quickly and completely. If they drag their feet or stuff is missing, it'll take longer.
Makes sense. And the closing timeline for the loan itself, from getting the contract from the approved builder to actually closing the loan.
Lenders often suggest allowing 45 to 60 days in your purchase contracts just to be safe.
Okay, a month and a half to 2 months.
Right. But they also say if the file is super clean, everything's in order, builder's approved, it can sometimes close faster, maybe under 45 days.
Good to have a realistic window. Can you insist on using your own title company, or do you have to use the one the builder or lender prefers?
Usually the builder has a preferred title company, and the lender might use them too for updates during construction. However, as the borrower, you generally do have the right to choose your own title company if you want to. It's just something you'd want to discuss up front.
Okay, borrower has the choice. Do you always need super detailed plans and specs for the house right at the beginning?
Oh, yes, absolutely. That's non-negotiable. The lender needs the full blueprints and specifications, what materials are being used, down to the model number sometimes right when the contract is submitted. They need to know exactly what they're financing.
No winging it.
Okay.
Got it. What happens if, heaven forbid, the appraisal of the finished home comes in lower than expected, lower than the loan amount you were approved for?
Yeah, that can happen. The lender can only lend based on the appraised value. So if it comes in low, there are usually 2 main options. Either the builder has to agree to lower their price to match the appraisal.
Which they might not want to do.
Right. Or the other option is you, the borrower, have to make up the difference in cash at closing. Bring extra money to the table.
Oof. Okay, good to be aware of that possibility.
Yeah.
Just to double check, these one-time close loans are construction to permanent, covering both phases?
Yes, correct. Construction and permanent mortgage all in one.
And you can usually finance the land purchase at the same time?
Yes, also correct. Land and construction financing bundled together is a common feature.
Okay. With the one-time close, when it converts from construction to permanent, do you have to go through all the underwriting stuff again, like income verification, credit check?
Generally, no, not for FHA, VA, or those jumbo ARM loans. For conventional loans, maybe, if the construction takes a really long time, say over a year. They might just ask for updated pay stubs or repull credit just to make sure nothing drastic has changed financially. But it's usually not a full re-underwriting.
That's a relief. Can you have a co-borrower? Like build with a spouse or partner?
Yes, absolutely. Co-borrowers are generally allowed. There might be specific rules about who qualifies as a co-borrower, like maybe not just a friend, but typically spouses, partners, family members are okay. Best to check the lender's specific guidelines on that.
Okay. What if you already own the land, free and clear, or have a lot of equity in it? Can you use that land equity as your down payment?
Yes, that's a huge advantage. If you own the land, the equity you have in it can definitely be used towards your down payment requirement.
How do they figure out the equity?
If there's a loan on it, it's the difference between value and loan balance. If you own it free and clear, and you've owned it for a certain amount of time, the exact time varies a bit by loan type, like 6 months for FHA, maybe only a day for conventional on it, then its value can count towards your down payment. Sometimes it can cover the entire down payment needed.
That's fantastic. Less cash out of pocket.
Yeah.
Okay, we touched on this, but just to be crystal clear, can you use these specific loan programs to build a house you plan only to rent out, an investment property?
No, flat out no for these particular programs. They are strictly for building your primary residence or a second home, single family only.
And that single family rule is strict. What about building a duplex, where you live in one side and rent the other?
Still generally no for these specific loan types. Even if you plan to live in one unit, they're typically designed only for properties built as single-family dwellings. No duplexes, triplexes, fourplexes.
Okay, single family, owner-occupied, primary or second. Got it. Now, during construction, let's say you sell your old house and have cash. Can you pay down the principal on the construction loan before it converts to permanent?
You can usually make extra payments after it converts to the permanent loan, but making big principal payments during the construction phase on a one-time close loan is tricky. And even if you pay it down after conversion, your required monthly payment won't automatically recalculate and go down.
It won't. So you'd still have the original payment amount even with a lower balance.
On a one-time close, typically yes. To get a lower payment reflecting the paydown, you'd likely need to refinance the loan. But remember that potential early payoff penalty if you do it within the first 6 months or so after conversion.
Right. So if paying down significantly right away is the plan, maybe that two-time close looks better again.
It could be, yeah. Or just plan to wait the required period, like 6+ months, before refinancing the one-time close loan.
Okay. Can you refinance the one-time close loan later on, say after a year or two?
Oh, yes, absolutely. Once you're past that initial period where penalties might apply, usually after 6 payments are made post-conversion, you can refinance it just like any other mortgage, penalty-free.
Good.
Yeah.
You mentioned the permanent rate floats until conversion for fixed-rate loans. What about adjustable rate mortgages? ARMs?
For ARMs offered in a one-time close format, the initial interest rate is typically fixed right at the start at the construction loan closing for whatever that initial fixed period is, like 5 years, 7 years, whatever the ARM structure is. So it doesn't float during construction like the fixed rate permanent option does.
Okay, so the ARM rate is set up front for its initial term. What about modular or factory-built homes? Are they ever eligible?
Sometimes yes, particularly under FHA guidelines. The key is they have to be off-frame modulars. That means they're built in sections in a factory but assembled on a permanent foundation on your site, and they look and function like a regular site-built home, not like a mobile home on a chassis.
So specific types of modulars might qualify. Good to know. Is there usually a limit on how much land you can include with the house? Like, can you finance a house on 50 acres?
The general rule of thumb seems to be around 10 acres max for these construction loans.
Just 10 acres.
Yeah, financing significantly more acreage than that with the house might be possible, but it'd likely be a case-by-case decision based heavily on the appraisal and whether the extra land adds proportional value. Usually they focus on the home site itself.
What if you want to buy, say, 20 acres, but only build the house on a typical lot size within that?
That's a tricky one. It really depends on how the appraiser values the whole package. Best bet there is definitely to call the loan specialist and explain the specific scenario.
Okay. Can you include building, like a small guest house or an in-law suite, an ADU accessory dwelling unit at the same time as the main house?
Generally, yes. ADUs are becoming more common. As long as it meets local zoning rules and maybe some size restrictions from the lender, you can often finance the construction of both the main house and an ADU together under the one loan.
Nice. What if the perfect piece of land already has an old, dilapidated house on it that needs to be torn down first?
Yeah.
Can the demolition cost be rolled into the loan?
Usually, yes. As long as the total cost land purchase plus demolition plus new construction doesn't exceed what the final new property appraises for, then yes, the demo costs can typically be included in the loan amount.
That's helpful. How long has this specific lender you researched been doing these kinds of loans? Are they experienced?
The source mentioned they've been specializing in construction loans since 2004. So yeah, that's quite a long track record, almost 2 decades of experience specifically in this niche.
That's reassuring. What if the lender isn't based in my state? How does that even work? Do I have to fly there?
Oh, definitely not. Nowadays, almost everything is handled electronically secure portals, email, fax sometimes. For the final closing, they usually arrange for a mobile notary to come to you, or you can close at a local title company. And crucially, the people doing the on-site work, the inspectors and appraisers, are always local professionals licensed in your area.
Okay, so distance isn't really a barrier. What if I don't want to build from scratch, but my current house needs a major renovation, like gutting the kitchen, adding a second story?
Yes. The same specialists who handle the new construction loans often handle major renovation or remodel loans too. They usually fall under conventional or maybe portfolio ARM programs, so definitely worth asking them about remodel financing if that's what you need.
Good to know. And do they also do just regular mortgages? Like if I just want to buy a normal existing house or refinance my current one?
Yep, the lender referenced is a full-service mortgage lender. They offer standard purchase and refinance loans to conventional, FHA, VA, USDA, jumbo loans, the whole range.
Okay. Are interest rates generally higher for construction loans compared to just buying an existing house?
That's a common misconception. The permanent interest rate you get after construction is finished is typically the same as the market rate for a comparable purchase loan at that time. Now, the interest rate during the construction phase might vary based on your down payment percentage, but the final mortgage rate isn't usually penalized just because it started as a construction loan.
That's really important. So you're not paying a premium on the long-term rate. Okay. Modular homes, again, you said FHA off-frame is okay. Any other types?
The key qualifier was really that off-frame aspect built on a permanent foundation, not resembling a mobile home. Best to confirm eligibility for a specific type of factory-built home directly with the lender.
How long does the builder usually get to finish the house? Is there a deadline?
The standard time frame built into the loan agreement is typically 12 months from the closing date.
1 year. What if there are delays? Bad weather? Supply issues?
Limited extensions, maybe 60 days or so, might be possible, sometimes for an additional fee. But generally, everyone aims to get it done within that first year. It's important to have that discussion about realistic timelines with your builder up front.
Absolutely. Does the lender have a list of builders you have to use? Or can you bring your own builder?
They often have a list of builders they've already approved, which can be convenient, but yes, you absolutely can use your own builder. They'll just need to go through the lender's approval process, first checking their license, insurance, financials, references.
So you have flexibility. They just need to vet the builder. Can you only have one builder?
You can only have one general contractor or builder of record who's responsible for the whole project and receives the loan draws. But that GC will, of course, hire various subcontractors, plumbers, electricians, roofers, etc. That's normal.
Right. One main point person for the lender. If the lender isn't local, how do they really know the construction is happening correctly? Who checks?
They rely on those local, independent, HUD-certified inspectors and local appraisers we mentioned. These are their eyes and ears on the ground. They visit the site periodically, check the progress against the plans, verify the work for each draw request. It's a standard industry practice.
Okay, that makes sense. How often can the builder actually request money, those draws?
Usually up to twice a month, tied to completing specific milestones laid out in the draw schedule.
And once a draw is approved, how quickly does the builder get paid? Is it slow?
No, it's usually pretty quick. Once the draw is approved by the inspector and you, the funds are typically wired directly to the builder within about 72 hours, so 3 business days.
That keeps the cash flowing for them. Good. What's the typical total time for the loan closing process again, roughly?
Around 45 days is a good average to expect, starting from when the lender gets the completed contract from your already approved builder.
Okay. Now the scary question. What if costs go up during building, more than the contingency covers? Can you just ask the lender to increase the loan amount?
Unfortunately, no. Once that loan amount is set and closed, it's generally fixed. Cost overruns beyond the initial contract and contingency amount are typically handled through those change orders we talked about.
And who pays for the change orders?
You, the homeowner, would generally be responsible for paying the builder directly for those agreed-upon extra costs out of your own pocket. The loan amount doesn't increase midstream.
Okay, crucial to understand, budgeting needs to be tight. Can you be your own builder? Like, act as your own general contractor to save money?
Generally, no. Due to federal rules and lender policies, these programs usually require the work to be done by a licensed, insured, third-party general contractor who is not the homeowner. It's considered a turnkey process where the builder delivers the finished home.
Okay, no DIY GCing. Does the lender offer loans directly to builders, like for building spec homes they plan to sell later?
No, these specific programs are all consumer direct. They're for you, the individual homebuyer or homeowner, building your primary or second home, not for financing builders' speculative projects.
Gotcha. And finally, that builder approval process. If they submit everything correctly, how fast again?
Usually pretty quick, maybe 3 to 4 business days, assuming all the paperwork is in order.
Okay. Wow, that was a lot of detail, but really helpful stuff. So we've gone through the weeds on construction loans. Let's zoom back out. It really sounds like the winning combo, the most streamlined path for a lot of people, is that one-time close loan paired with a turnkey builder. Can you just quickly remind us what those two things are?
Sure. So the one-time close loan, like we said, is that single loan covering construction and the permanent mortgage. One application, one closing. And a turnkey custom builder is basically a company that manages the entire build for you, from design help, permits, managing all the subcontractors, materials, everything, until they hand you the keys to your finished custom home.
They handle it all. And why is that combo, OTC loan plus turnkey builder, seen as the preferred method?
Because it just creates such an efficient and predictable experience.
Yeah.
You simplify the money side with one loan, one closing, And you simplify the building side by having one professional team manage all those moving parts. It really takes a lot of the complexity off your plate as the homeowner.
Yeah, reducing stress seems key. We looked at an article, Unlock Your Dream Home Build, that actually listed the top 10 reasons why this combination is so effective. Maybe we can just quickly hit those highlights again. They really summarize the benefits well.
Absolutely. Good idea. So number one was that rate conversion advantage, the chance to snag a lower permanent rate if rates drop during the build. That's potentially huge savings.
Right. Number 2, slash thousands in closing costs, only paying those fees once instead of twice. Big budget impact.
3, eliminate requalification roulette. You qualify once at the beginning, no stress about having to qualify all over again when the house is done.
Huge peace of mind. 4, unparalleled convenience. Just one application, one closing to deal with. Much simpler.
5, a seamless transition. The loan just automatically flips from construction to permanent. No extra steps needed from you.
6, integrated land acquisition. Often you can buy the land and finance the build all in that one loan. Super easy.
7, the perfect partnership. The streamlined loan process works hand in glove with the turnkey builder managing the whole project. Everything flows better.
8, enhanced budget oversight. Having one loan and one main builder contact gives you clearer financial predictability.
9, optimized construction draw process. Efficient payments to the builder help keep the project moving smoothly and on schedule.
And wrapping it up, 10, comprehensive risk mitigation. This combo helps manage risks around interest rates, requalifying, closing costs, paperwork hassles, and just the general stress of overseeing a big construction project.
Exactly. It really covers a lot of the bases, tackling the common worries and potential bumps in the road when you're building a custom home.
It really does sound like the smartest way to approach it if you can. So if someone's listening now and thinking, okay, I'm intrigued, this actually sounds doable, what's the very first thing I should do?
Well, the best first step is usually to talk to the experts, the people who specialize in these construction loans day in and day out. Get your specific questions answered based on your situation. You can actually reach construction loan specialists directly by phone.
Okay, do you have the number?
Yes. The number provided in the resources we looked at is 888-857-8041. Calling them lets you talk through your scenario and see what might be possible.
888-857-8041.
Got it. And wasn't there a YouTube channel mentioned too?
Yes. The channel is at Custom Home Construction Loans. The sources suggested it's a really helpful resource, lots of videos explaining things, answering questions. So that's another great place to learn more, maybe see some visuals.
At Custom Home Construction Loans on YouTube. Okay, great resources.
Definitely worth checking out. So really, the big takeaway here feels like building that custom dream home, the one you've maybe had in your head for years. It's actually genuinely within reach for more people than they might think, especially with these tools like the one-time closed loan and finding the right pros to work with.
Absolutely. It's about knowing these options exist, getting informed, and then being strategic about how you approach the financing and the build itself.
Okay, so here's a final thought for you listening. Take a second and really think about your dream home. But go beyond just, the number of bathrooms or the countertop material. What kind of life are you actually trying to build in that space? What does that feel like? Because taking that first step now, just exploring these loan options, calling that number, that could be what turns that vision, that feeling, into a real place you call home. Maybe way sooner than you imagine. It's about building a life, not just a house.
Well said. And if you are ready to take that first exploratory step, that number again to connect with the construction loan specialist is 888-857-8041. It's the starting point to getting the personalized info you need for your potential dream build.